Hi, good morning class. Welcome to the next lecture of mine of Managerial Economics. So in this lecture we are going to have a discussion that what is the importance and what are the fundamentals of managerial economics. In previously we have discussed the meaning, that what is the meaning of managerial economics and how managerial economics played a very important role in solving the various issues or various problems which takes place in the business organization. So in this lecture we are going to have a discussion about the importance and fundamental principles of managerial economics. So, as we all know that managerial economics is a combination of two words, that is managerial plus economics. Economics means the use of best possible resources or the best use of the available resources with least wastage or without wastage. And what is managerial? Managerial means the practical implementation of the theories of economics for the smooth and proper running of the business organization. So, managerial economics is a combination of two words, managerial and economics. Managerial economics in economics applied in decision making. We have already discussed that this theory helps in the process of decision making. It links between the abstract theory and managerial practice, and it helps in identifying the problems, organizing information and evaluating alternatives. That means it is a brief analysis that what is the problem and how that problem can be solved with the various available alternatives in the market. So this is all about the managerial economics. Origin of managerial economics. The origin of managerial economics is from the scarcity. Scarcity means the shortage of any resources. If there are shortage of certain resources, then how that shortage can be compensated by the best possible utilization of available resources in the market. So that is all about the managerial economics, how to manage the scarcity problem by utilizing the available resources in the market. Managerial economics is evolved as an important toolkit which is useful in decision making for the manager. The development of managerial economics as a separate discipline has a recent origin in Joel Dean's book Managerial Economics, which is used to publish in 1951, and due to wide recognition of the uses of economic theories in decision making of the business, this subject becomes most relevant subject in today's era. Concept of managerial economics, which deals with the application of economic theories, concept, fundamentals, methodologies to apply in a practical manner in order to solve the various problems which are being faced by the different business organization. So we can also say that managerial economics is the problem solving technique by the practical implementation of the various economic theories. It uses the tool and techniques of economic analysis to solve managerial problems or to achieve the firm's desired objective. It is that branch of economics which serves as a link between the abstract theories and managerial practices. So it is all about identifying the problem, organize the information and evaluating the alternatives which are available in the market. So this is all about what that how the available resources can be utilized in best possible manner in order to meet the objective of the business organization. So it can also be said that managerial economics borrows theories from traditional economics, that is microeconomics, where as it borrows tools from decision science, that is mathematics and statistics, and it tries to find out optimum solution of business problem. Yes, by taking the help from various fields like mathematics, statistics, microeconomics, it helps in identifying the problem, analyzing the problem, and give the perfect solution to overcome with the problem. So now you can see the diagram that is in between, in the middle, that is managerial economics, and it is surrounded by the various alternatives, that is management problems, decision science, study of functional areas, accounting, finance and marketing, optimal decision, economic methodology, descriptive and prescriptive model, economic theory. So you can see that in the middle there is a managerial economics, and it helps in dealing with the problem of various subjects, that is management, decision science and various other fields. So we can say that managerial economics helps in dealing with the problem in various areas. Features of managerial economics: microeconomics character, that means managerial economics is microeconomic in character because it is a unit of study is firm. However, it always takes the help of macroeconomics to understand and adjust to the environment in which the firm operates. Yes, the managerial economics works at micro level because it helps in recognizing the environment in which a particular firm operates and what kind of environment is being needed for the proper and smooth running of the business organization. So that means managerial economics works at a micro level. Choice and allocation. We have already discussed about the problem of choice and allocation, means how the available resources can be properly distributed to achieve the desired objective of the business organization. Goal oriented means how the goal of the business organization can be achieved. If you have a focus point on the goal, if you are a goal orienter, then definitely you can achieve the goal of your future. So it also known as the choice and allocation and goal oriented. How managerial economics is useful: evaluating choice alternatives, that means identify ways to efficiently achieve goals, specify pricing and production strategies, provide information, production and marketing rules to help maximize net profit. That means how managerial economics is useful in the betterment of the business organization or in maximization of the profit. That is only possible by evaluating choice alternative, and that choice alternative is to achieve a result. That choice alternative can be of pricing or production strategies, that can be the relate with the production process, marketing rules, which helps in maximizing the profit of the business organization. Making the best decision. So various resources are available, and by the proper utilization of the available resources, the proper decision can be taken for the smooth running of the business. So it is known as making the best decision with the use of managerial economics. Fundamental concept principles in managerial economics. Now we are going to have a discussion that what are the principles on which managerial economics actually works. So these are some of the principles: incremental principle of times perspective, opportunity cost discounting principle, equi-marginal principle, and risk and uncertainty. So these are 6 principles which is applied in managerial economics to overcome the problem which takes place in any business organization. Incremental principle. Incremental concept is closely related to the marginal cost and marginal revenues of economic theory. Marginal means the addition of one more unit is known as marginal. Suppose you have manufactured 20 units and there is a demand of 25 units. So you have to produce 5 more units. That means in the production of 5 more units there is an extra cost. So that extra cost is known as marginal cost, and the profit which company takes from the production of those 5 extra units, then that is known as the marginal revenue. So the production of extra unit or one more unit is known as the marginal. The two major concepts in this analysis are incremental cost and incremental revenue. So incremental cost may be defined as the change in the total cost resulting from a particular decision. Suppose you have estimated that there is a total cost of 25 lakh, but due to some reason or the other it becomes 26 lakh. Then what is the point? So that 1 lakh extra cost is known as the incremental cost. Incremental revenue. By that 1 lakh, if the company is earning more profit, then that is known as incremental revenue. According to the incremental principle, a decision is profitable if it increases revenue more than cost, it decreases some cost to a greater extent than it increases others, it increases some revenue more than it decreases others, it reduces cost more than revenues. So the term, it can be said that the cost is an incremental cost if it is less than the cost of production. For example, some businessmen hold the view that to make an overall profit, they must make a profit on every job. The result is that they refuse orders that do not cover full cost plus a provision of profit. This will lead to rejection of an order which prevents short-run profit. Suppose a new order is estimated to bring in an additional revenue of rupees 10,000. The costs are estimated as labor 3,000, material 4,000, overhead charges 3,600, selling and administrative expenses 1,400. So the total cost is 12,000. The order appears to be unprofitable, for it results in a loss of rupees 2,000. You have estimated the additional revenue of 10,000, but the full cost which takes place is 12,000. That means you are paying 2,000 more. Principle of time's perspective. The time perspective concept states that the decision maker must give due consideration both to the short run and long run effects of his decision. So if we talk about the time perspective, the decision maker should give proper time in taking the decision, whether the decision is for the long term or whether the decision is for the short term. So the person who is acting as a decision maker, that person has to give a due consideration to both types of decision, whether it is for the long run or whether it is for the short run. By short run, they mean that period within which some of the inputs called fixed inputs cannot be altered, while in the long run all the inputs can be changed. Fixed means that is fixed, that cannot be changed. For example, land, machine, building. So these are known as the fixed input, which cannot be changed in the short run, but it can be changed in the long run. In the short period, the firm can change its output without changing its size. In the long period, the firm can change its output by changing its size. A decision may be made on the basis of short run consideration, but may, as time elapses, have long repercussions which make it more or less profitable than it at first appeared. That means the person who is a decision maker, that person has to pay a due time in taking the decision whether for the long run or for the short run. Both type of decision plays a very important role for the smooth running and for the success of the business organization. Now there is an example. With this example, it is clear that how the principle of time's perspective plays a very important role. You can go with the example. Now the next is opportunity cost. So first we have discussed about incremental principle, then second is the time's perspective, in which we have paid due attention to the decision, no matter whether the decision is for the long run or the short run. Now the third fundamental principle is about the opportunity cost. Resources are scarce. We cannot produce all the commodities. For the production of one commodity, we have to forego the production of another commodity. We cannot have everything we want. We are therefore forced to make a choice. Whatever we have think, we cannot produce all the things whatever we have planned in our mind, but we are forced to make a choice. So we have to prioritize the planning process, that which type of production goes first, second and third. Opportunity cost of a decision is the sacrifice of alternative required by that decision. Sacrifice of alternatives is involved when carrying out a decision requires using a resource that is limited in supply with the firm. Opportunity cost therefore represents the benefits or revenue foregone by pursuing one course of action rather than other. The calculation of opportunity cost involves the measurement of sacrifices. Sacrifices may be monetary or real. The opportunity cost is termed as the cost of sacrifice. Suppose you have two options. Option A is well and option 2 is very well. So you have to go with the option B, and if you are going with the option B, then you have to make a sacrifice for the option A. So that sacrifice is known as opportunity cost in managerial economics. For prevailing the benefit, the most benefit, you have to sacrifice one thing over another. So that sacrifice is known as the opportunity cost in managerial economics. It helps in determining relative prices of different goods. It helps in determining normal remuneration to a factor of production. It helps in proper allocation of factor resources. For example, opportunity cost for one table is 3 chairs and price of a chair is rupees 100, while the price of a table is rupees 400. Under such condition, it is beneficial to produce one table rather than 3 chairs, because if he produce 3 chairs he will get only rupees 300, whereas a table fetches him rupees 400. So producing a table in place of producing a chair is known as the opportunity cost. That means the person has sacrifices the manufacturing of chairs with the manufacturing of a table. Next principle is Equi-Marginal Principle. The principle states that an input should be allocated so that value added by the last unit is same in all cases. This generalization is popularly called the Equi-Marginal. Let us assume a case in which the firm has 100 units of labor at its disposal and the firm is involved in 5 activities A, B, C, D and E. The firm can increase any one of these activities by employing more labor, but only at the cost, that is sacrifice of other activities. An optimum allocation cannot be achieved if the value of the marginal product is greater in one activity than in other. For example, if there is a production in 5 departments, then you have to make choice or you have to cut the labor in any of the department. Just so, if you are cutting the cost of labor in any one department to complete the production of the other department, so that is known as the Equi-Marginal Principle. That means here you are doing the action just to equalizing the things between the other departments as well. So to maintaining the balance between the two things is known as Equi-Marginal Principle. For example, the value of the marginal product of labor in activity A is rupees 50, while that in activity B is rupees 70. Then it is possible and profitable to shift labor from activity A to activity B. The optimum is reached when the values of the marginal product is equal to all activities. This can be expressed symbolically as follows, where VMP is the value of marginal product, L is labor. So that means if the marginal product, if a labor is producing anything in activity A and activity B, and the same labor is doing well in the production of activity B, so it is profitable to go with the activity B just to maintain a balance between activity A and activity B. The principle states that an input should be allocated so that the value added by the last unit is the same in all cases. This generalization is popularly called the Equi-Marginal. That means to maintain equality between the allocated factors that takes place under different situation in any business organization. Discounting principle or the time value of money. This concept is an extension of the concept of time's perspective. Since future is unknown and incalculable, there is lot of risk and uncertainty in future. Everyone knows that a rupee today is worth more than a rupee will be 2 years from now. This judgment is made not on account of the uncertainty surrounding the future or risk of inflation. It is simply that in the intervening period of a sum of money can earn a return which is ruled out if the same sum is available only at the end of the period. That means discounting principle, that in today what is the value is 500 rupees, then that value cannot remain same after a period of 2 years. सो इट इज़ नोन एज टाइम वैल्यू ऑफ मनी. आज जो 500 रुपये की कीमत है, आने वाले 2 साल में वही 500 रुपये की कीमत सिर्फ 100 रुपये के बराबर रह जाएगी. So that is known as the time value of money or the discounting principle. Risk and uncertainty. If you are talking about the business, so in business you have to keep yourself ready to bear the risk or to bear the uncertainty. Managerial decisions are actions of today which bear fruits in future which is unforeseen. Future is uncertain and involves risk. The uncertainty is due to unpredictable changes in the business cycle, structure of the economy and government policies. The risk and uncertainty in the market can be with any of the reason due to inflation, due to deflation, due to changes in business cycle, structure or the change in the government policy. Demonetization is the best example of risk and uncertainty. Economic theory generally assumes that the firm has perfect knowledge of its cost and demand relationship and of its environment. Uncertainty is not allowed to affect the decision. Uncertainty arises because producers simply cannot foresee the dynamic changes in the economy and hence cost and revenue data of their firms with reasonable accuracy. That means if you are in a phase of business, then you should always prepare yourself to bear the risk and uncertainty, and that risk and uncertainty can be related with the production, can be related with the market, can be related with the government policies or any other factor. So this is all about for this lecture. Now we will meet in the next lecture of managerial economics. Till then, have a nice day. Stay safe. Thank you.